Welcome to this week's Closing Bell. Jason Jacoby, Mark Boyer here.
Hi, Jason. How are you today?
Doing great. How
Awesome.
are you?
I'm doing great. Doing well.
Beautiful sunny day. Beautiful summer so far.
Yeah, we got a big birthday tomorrow, right?
Yeah.
Hello, Jackson.
My son's third birthday.
Well, it was actually this week, but we're having a party tomorrow, so that'd be fun.
It'd be really fun.
Third
Good to
birthday.
Celebrate him.
Father's
Yeah.
Day. It's awesome.
Changed my life forever for the best, so it was good.
I love him. So cute.
But anyway, so lots to talk about. Actually, not that much to talk about today. Let's just dive in, keep it short and simple here for you. But S&P 500, a lot of people are looking at valuations where we're currently at. A lot of analysts that we've been reading and talking to have kind of tempered their expectations. We actually had a call this morning with a global manager. Mm-hmm. They were a little bit more cautiously optimistic just with how things have gone so far this year. S&P earnings, what are we at now? 25 and change. Estimates down in the 2,300 range. Yeah. So why don't we talk a little bit about that? So what are your expectations? Are we tempering expectations a little bit, or?
Yeah, I mean, so we're starting earnings season. This next week is actually when the barrage of earnings start coming in. We've seen some banks this last week, but now we'll really get a bulk of our earnings, and overall expecting about a negative 7.4% earnings per share in the S&P 500. And we'll just see how that plays out. I mean, it's going to be interesting to see. If there's, if we hit expectations or if they, are above or below, we just don't know. It's been an AI move. We talked about the NASDAQ. It's been crazy. What I have liked recently is the change in sort of the breadth of the market. The Dow actually has been outperforming the S&P and the NASDAQ in recent days. So that's good. And to your point in regards to, people that we've been talking to, managers and so forth, they are a little concerned that it's a little bit hot. Earnings are not, expected to go down. They're not really going up when they do that high, and yet the multiples, P ratios are going up. So it's cautious. Again, coming back to, large cap, multinational, dividend paying kind of companies that look to be the place to be. It's probably why the Dow's moving in here right now. I think that's where people are moving, and we've been there as well, but I think that's what's happening. And also, that perhaps the international piece, maybe there's credible opportunities outside the U.S. for the same multinationals that are, have a global footprint. I mean, it works pretty well. Yeah. So we talked about that before and earlier, but still, that seems to be the place to be looking at right now.
So if you have been listening to what the sage advice here has been said by Mark is, hey, take a cautious approach. Caution doesn't have to be pessimistic necessarily. No. It's just, hey, in a portfolio that you've built out or we built out for you, it's important to remember that there's a seat at the table for those boring companies, those dividend payers, those even the bond side of things, attractive valuations, great interest payments on those. Yeah. And then you can have the flash in there, but temper the expectations. It's part of an overall portfolio. Have things that perform in different market cycles where when earnings are going down, inflation runs a little bit hotter, unemployment starts to increase, whatever it may be, you have a part of the portfolio that can withstand those different market cycles.
Correct. Yeah. So that's what we're talking about. Just being diversified, having a game plan that you can make moves whatever and wherever you at the time you need. I mean, in growth, still like the growth areas, right? I mean, we still like those. The momentum is hard to fight the market. Like to see them go sideways at least, or even come down a little bit to some moving averages that look, look reasonable to maybe add some positions into those places too. So we're doing and working with clients on that as well, where those, with new money and so forth. So it's all part of a balanced portfolio. It's time in the market, not timing. Remember, time in the market, not timing. You got to have time in the market. A lot of times in our culture today, everything's quick. Microwaves, fast. Internet. I mean, if our internet is slow, right? And we all get frustrated, everything happens. We're like, what's wrong with the internet? It's too slow, right? So we're just a fast-paced culture, and yet investing, good, solid investing is a long-term. It's hanging in there through it all, kind of like life. I mean, so many life stories in it too, is hanging it. So anyway, that's what diversification and true investing is longer term.
Love it. We'll see you next week. Thanks so much for joining us.